When it comes to the euro crisis, will austerity work? Let's consider a simplified form of a domestic government budget constraint. Government spending is equal to tax revenue taken in plus the amount of money borrowed. Note that the term austerity can have multiple meanings. Austerity could refer to a decrease in government spending, or it could also refer to an increase in tax revenue and/or tax rates. When people write about austerity, they're not always clear what they mean. Be careful. Let's first consider raising tax rates. In the short run, and indeed in the long run, this is usually bad for an economy. It damages productive activity, and it also hurts what macroeconomists call aggregate demand. That is, consumers have less money to spend, and capitalists may also be less eager to invest. Sometimes raising taxes may be necessary, but it's not really going to bring about a solution to the euro crisis because it means shrinking economies and shrinking economic growth. There's also the problem that raising tax rates doesn't always bring in more tax revenue. If either taxes are already quite high, as is the case in France, or the tax collection apparatus is fairly ineffective, as is the case in Greece, then trying to increase taxes is not always an effective policy lever, even if it's something you might like to do. A second approach to austerity is to cut government spending. This too has some economic problems, in this case especially in the short run. It also hurts aggregate demand. It may mean, for instance, that public sector employees are laid off and then they have less money to spend. It may lead to civil unrest and more uncertainty surrounding investment. And finally, depending where the spending is cut, it may lower the investment in an economy's future. For instance, there may be less spending on education. A lot of economists believe that the spending which ought to be cut is transfer payments, often transfer payments to the relatively wealthy, but in practice what often tends to be cut is discretionary spending, so government spending cuts are very often not done in the most effective or efficient ways. As with tax increases, government spending cuts bring some risk of a downward spiral, portrayed here. For instance, imagine that taxes are going up and government spending is going down. That means in the short run, GDP is falling. That means in turn that less tax revenue is being collected. That's falling too, and that can worsen a country's budget deficit, which in turn requires further tax increases or further cuts in government spending, therefore leading to a kind of vicious cycle. You don't have to be a Keynesian economist to worry about this kind of problem. Let's say you take a view which is really quite cynical of a lot of government or public sector spending, and you think that a lot of it goes not, say, to educating children, but that a lot of it is wasted. Shouldn't we cut that spending? Well, in general, yes, we should cut that spending, but keep in mind the particular position of a lot of the Eurozone economies today. They do not have flexible labor markets, and they're undergoing a lot of credit contraction. So in a well-functioning economy, it might be the case that we could cut wasteful government spending, and that would pretty quickly lead to an increase in private sector output. But if the labor market is not working well, and if credit markets are not working well, what may happen instead is that when we cut government spending, we simply get GDP going down, and the private sector really doesn't have the kind of uptick that we might like it to. There is an economic literature on what are the best adjustments to a financial crisis, and most analysts agree. What's good is to have a falling exchange rate through depreciation or devaluation, to balance your budget in large part by spending cuts, cutting spending on the wasteful items, to go relatively easy on tax hikes, and for your economy to have decent fundamentals and perhaps a fairly loose monetary policy. But if you look at the Eurozone, not all of this is going to be possible. The falling exchange rate, well, that's determined by the Eurozone as a whole, and you can't get a falling exchange rate relative to your trading partners within the Eurozone because you have the same currency. Spending cuts and tax hikes, in most of the Eurozone economies, there have actually been a lot more tax hikes than spending cuts. Spain, for instance, has done a lot to increase taxes, but not that much to cut government spending. Greece is one country that has made some real cuts to government spending. And finally, at this point in time, there really aren't decent fundamentals in place for a lot of these economies, so the adjustment is going to be tough. If you'd like to read more on this general topic of how to adjust to financial crises, I recommend this piece, which is available online and free. So in these situations, austerity can work, but it's actually a pretty painful path. For one thing, wages must fall. This can come through a mix of tax hikes, lower benefits, or sending more money to a nation's creditors. It also means that consumption must fall. Note that wages falling and consumption falling, that can tend to restore a nation's trade balance by cutting back on imports. Government spending must fall, and some government benefits must fall, and you put all of those things together, you can see it's not very popular. Let's now go back to the three fundamental economic problems of the Eurozone as identified by the video of that name. We saw they were a banking crisis, capital imbalances, and a government budget crisis. What austerity does is it does address capital imbalances by limiting imports. It also, to some extent, may help a government budget crisis by raising taxes and cutting spending. But it turns out that it usually worsens number one. That is, it gives you a greater banking crisis because you have falling output, and that makes banks less solvent, and that leads to more bank runs and more capital flight, and that in turn damages output and may require some more austerity. Well, if austerity is so painful, what are the alternatives? One of them is external aid, and of course there's been a good deal of that in the Eurozone. But note that external aid often just postpones problems, and in a lot of cases that aid is loans and it still has to be paid back. In the meantime, a country may defer making difficult but necessary decisions. The second alternative is to simply default on one's debt, as, say, Argentina has done. One thing to note about default is that it may cause a European or maybe even a global financial crisis. But a second problem with default is once you default, it's much harder to borrow money again. And if you can't borrow money, well, there may still be a budget imbalance, and very often austerity still comes. So defaulting need not get you out of the austerity trap. It may just mean you live through that trap in a situation where you cannot easily access international capital. Finally, you can borrow more, spend more, and hope for the best. That can work if rapid growth will resume, but right now we don't see too many signs of that in the Eurozone.